Hey everyone, welcome to our latest Trade of Black podcast Sunday night version. I am your host, Shad Dales. Thanks for checking in. Small Cap Sunday. We're back for our second show. And this week, as we said last week, we're going to dive into specific companies. We gave you basically the headline, the requirements of the companies that we're going to be following and why. Well, this week we get into details as to which company those are. As many as 1,400 small cap companies that we want to cover here in North America alone. We got a lot of work to do. So let's dive in, including one cannabis company here tonight, and welcome in TDR Head of Research and Lead Financial Writer, Bill McNarland. Good to see you. How are things?
Things are excellent. Had a great weekend yourself?
Yes, busy week. I'm sure obviously you heard the news as to what went down in Washington with the DEA, but that was very busy to say the least. But we got some good feedback from our first show. And I know that we basically outlined some of the requirements. These are small cap companies that we want to target that has a market cap between 250 million and 2 billion. So again, walk us through maybe some of the quick highlights and the requirements as to the companies that you're watching and why they're interesting you, that include like gross margins and levered free cash flow, some of those things.
Yeah, just simply, just if we're running a business ourselves, we want to make sure that we have revenue and that the revenue is growing. We also want to make sure that these companies are something of interest to our audience as well. And then we want to make sure that they have profits as well and free cash flow, cash in the bank, and dividends are a beautiful thing as well. And so these are the things we're looking at because we have so many thousands of companies to look at. Let's find the best ones.
Yeah, and avoid the pump and dumps. Great.
That is correct. And it's so far from what we're doing. Yeah,
I know. All right. So to highlight again, revenue and growth of the company to industry, growth catalysts. What is the gross margin, levered free cash flow, along with net income? And finally, one important thing too, as you said last week, is credit score. Before we get into it, all views on the Trade of Black podcast and the guests on this podcast are purely opinion. You should not treat any opinions expressed by us or guests as investment advice. And the views on this podcast are solely, intended to be informational and are not investment advice. Okay, let's get into it. As we said, we want to dive more into specific companies this week. So the first one is actually a company and it involves in the beverage industry. Again, these are companies, they're industries that we want to cover off that we think are going to be entertaining and interesting for a lot of our viewers. So this company, it's called Angostura Holdings. It's based out of Trinidad and Tobago and is producing actually some real good revenue from what we've seen. So one, how did you find out about this company and why does it interest you, Bill?
First of all, I'm looking at companies all around the world. So thousands and thousands of companies, regardless of where they're from. And what caught my eye here, I found so fascinating is, first of all, this company's 200 years old. They're celebrating this year their 200th anniversary. They're down in Trinidad and Tobago. They've been in the rum business. But this was actually a household bar name, or a bar name, I guess you could say, because they invented the famous Angostura bitters that we see in bars whenever someone orders a cocktail like an old fashioned or a Manhattan. This was the company that invented that.
So a story within the story. 200 years old.
Yeah, and it's this year. It's that they're celebrating their 200th anniversary. And it's this week or the next 2 weeks, we expect to have their next annual report celebrating this 200-year milestone.
Okay, so accessibility for investors. How easy is it? Where does it trade on? And what's the market cap?
I can purchase it at Interactive Brokers. I'm not sure which brokerage everyone else is using, but as globalization gets bigger, companies there's more brokerages that you can purchase it through. It's on the Trinidad and Tobago Stock Exchange. And eventually a lot of these companies too end up with a multi-ticker in different jurisdictions as well. Now the market cap is $700 million. So
wow, okay.
We're going to learn about our second company, which is a household name. It has a similar market cap. This is extremely large.
Okay, so let's look at the charts right now, and really healthy, as I said off the top. We've got revenue of $156 million from last year. So what has been the 5-year trend of the company on revenue growth?
The 5-year trend's been 6.2% from the previous annual report to their last one. They had 12-month revenue growth of 11.8. So let's put this in perspective a little bit.
Yep.
Liquor, wine, and beer globally is growing between 4 and 5%, depending on which class they're in. So this company is outpacing the general growth of the industry. So far, this looks to be something quite positive when we're looking at the growth levels of revenue.
Why is it, I guess, outpacing the overall industry? Any idea?
They went into some other verticals like non-alcoholic, but non-alcoholic is not necessarily growing much quicker in the industry. But they already have distribution agreements, so it just adds one more thing that they can add on to. And secondly, there's the intrigue of international countries wanting to become more sophisticated in the products they buy. And so
Yep.
instead of so when you go from a third world country to a second world country, instead of people just drinking beers, they start to move into cocktails and fancy cocktails that need stuff like bitters and such. And so naturally, you can see why they would be leading above the industry average globally because of the subset that they're in.
And eventually, cannabis, right? I think you'll see
It's
that one
it's
day.
it's just a natural fit that all of these liquor companies would consider moving into something like cannabis, or there's some mergers or acquisitions. And that's something also to look out. I think companies like this, a lot of the liquor and beverage companies we look at will be acquisition targets, either
Yeah.
from liquor conglomerates, like we
Yeah.
talked about last week in Pernod in France, or with cannabis companies as well that have potential complementary distributions.
Okay. So I was going to ask you about any near-term growth catalysts or highlights, but you kind of indicated that they've gone outside of just, their normal industry that has generated why they're outpacing the overall industry itself as far as growth. But I do want to jump into dividends. Not all companies that actually were going to provide, or at least follow, provide a dividend, but in this case here, they do provide one, as you said, and it's been consistent. So what's the yield at right now?
Yeah, the yield right now is 1.7. The dividend growth has been 3.1. So the dividend is not growing as quick as their revenue, but we have some clues later on that we can see there's a difference where their leverage free cash flow is less than their net income, and that's because they're doing capital expenditures. They're
Yeah.
building new parts of their factory or whatever. So instead of paying dividends to investors and growing it at the same rate as revenue, they're choosing to reinvest in their business, and there's nothing wrong with that. That's a business decision where they think there's going to be more value for shareholders in the future.
Okay, next column I want to look at is gross margins. What did you find? And really, when you look at this, how does this compare, do you say, from the cannabis industry that we cover?
Well, the magical number in cannabis is to get to 50% gross margins, and most of the
Yeah.
companies aren't there yet. But that's the goal, and they often state that on their conference calls with analysts. This company is established, and they're just under that. They're at 48.1%. So they're
Okay.
close to that ideal 50% gross margin that everyone is striving for.
Okay, so let's look at free cash flow, which I think a lot of retail investors are starting to educate them on in the next column. So, what we find?
So I'm always talking on the show about levered free cash flow. It's not
Yeah.
commonly that someone talks about this. And I'm going to give you a couple of examples why. This is the cash that you have in the bank after
Yep.
you paid all your expenses, including things that are not are normally amortized for expenses. So I'll give you a quick example. As a small business owner, if you need to buy $10,000 of computer equipment at Amazon or Best Buy tomorrow, do you have to pay the credit card company this month, or can you pay it over 5 years? No, you pay this month.
Right.
But in accounting, we end up depreciating that as an expense over 5 years. I want to know cash flow. So that's why I look at this instead of net income. I want to know the actual cash in the bank after all capital is paid, as expenses are paid. And so in their last 12 months, they had 12.4 million US dollars in leverage free cash flow left over. And that's a very positive thing to have positive cash at the end of a reporting period.
Bill, why do you choose to go that approach? Because you don't see it a lot in the industry, but I wouldn't say the industry, but do you see it a lot in the industry? I don't want to. I shouldn't say industry as far as cannabis, but overall, when it comes to accounting, in the public market ecosystem, do you see a lot of that approach with the style and the approach that you're outlining when it comes to accounting?
My approach is very different, and that's because I've had two jobs in my life. I've been an analyst and an entrepreneur. So if I'm running a small business, I have to know where's the cash flow in the bank over the
Right.
next 3 months, 6 months, 12 months. And so because of that, when I look at a public company, I naturally take what I've also learned as an entrepreneur when looking at these businesses as well. So I have my entrepreneur hat on, and then I also have my analyst hat on as well.
Okay, good to know. Last thing I want to check on, as you outlined last week, is it's easy for people to actually obtain and to review online, but what is the company's credit score?
Yeah, so just as a reminder, if you didn't see our last episode, when we're checking credit, it's very similar to a personal credit score like a FICO. If you're 1.8 or below, there's some risk over the next 2 years to your business. 1.8 to 3 is a yellow flag. Above 3 is a green flag. This company came in at 14.4. So
Okay, so
there's no
strong.
credit concerns. It is has an iron strength to a balance sheet.
Okay. And I know we like to highlight companies that we're interested in and potentially could invest in. So do you give this the TDR, Small Cap Sunday stamp of approval as far as owning this stock?
I'll give it a conditional one upon finding some more information. So when I look at this company, this is an excellent business, but that doesn't mean that's the time to buy a stock. So I want to
Okay.
look more into the valuation. So it looks actually right now that the valuation is fairly rich, and that's not a bad thing. That means investors appreciate the business. But for me, I'd rather buy something at a time that's more inexpensive than expensive. So I'd really want to talk to management to get more of a sense. I have the annual report that's coming out, I believe, in a week or two, which I'm going to dive over. And I can report back on those findings, either that I get from management or the annual report. If it has the final, it moves from conditional to stamp of approval.
All right. So we're neutral on this one, but we'll find out more information. All right. That's the first company that we're highlighting. Let's move on to the second one. And this is actually a more notable company name. They're actually out of Toronto, Canada. IMAX, which trades on the New York Stock Exchange under the ticker symbol IMAX, which I think to your surprise and to my surprises too, is this is a small cap stock. And you kind of gave a comparison based on market cap size with our first stock. You want to elaborate off of that?
Yeah, so I'm sure most of our viewers never heard of the first name that we brought up,
Yeah.
but IMAX, I'm sure everyone knows, but their market caps are similar. 700, around 700 million or 800 million for IMAX, depending where it opens on the market on Monday. So these are similar size companies. And so that kind of illustrates how many large companies there are out there that people aren't aware of that potentially we could look at for investments.
Does that surprise you? A $700 million valuation of a company like that's well known that trades on a senior exchange?
I say it surprised me maybe 15 or 20 years ago when I started to look into it. But then I realized when I started to do this research in the past, when I was an analyst for an asset management company in the small cap side, I realized that there was just thousands and thousands of excellent businesses around the world that the average investor had no idea about.
Hmm. So why do you think the valuation is where it is here in 2024?
Well, when I look at valuations in small caps in general, right now, over the last 20 years, small caps typically traded at a higher multiple than large cap companies because they had faster growth. But that's fluctuated through time. But currently, RBC just put out a report on small caps that I was reading, looking at valuations. And their headline was actually that this was the best time in the last 20 years to buy small caps. This is and we also see
That's
this in the
interesting.
S&P 500 because everyone's just interested in the huge mega names and
Yes.
not even looking at the last 490 companies in the S&P 500. Similarly, small caps are being forgotten because everyone's chasing the large names. And I think that's the reason why there's an opportunity for this right now. And RBC wrote a report about it and agrees with our thesis as well.
All right, well, let's head to the chart. We look at revenue right now, which I'm sure this company is anticipating some strong numbers based on the recent movie release of Dune 2. Do you want to elaborate off that?
Yeah, so IMAX has changed their business. It's not the business that when we first went to a movie 25 years ago, and we're super excited to see a big screen.
Right.
Part of their business now is in the specialty cameras that they're filming movies. So Dune 2 is an example. That was an unbelievable movie. Potentially, it's even a documentary. But when you look at this, 100% of that movie was filmed with IMAX cameras, compared to the first movie, which was famous for cinematography, was 40%. So
Yep.
why is that important for IMAX? Well, everyone wants to go to an IMAX theater to see the full picture. So, for example, with that movie, they had a 22% of market shares. People that went to go see Dune 2, 22% sat in an IMAX theater. Normally, it's only 3.2%. And 5 years ago, it was only 2.5.
So it's grown.
So it's huge. There's a big
It
potential.
probably
Now,
helps. that Las Vegas sphere is definitely going to open up a lot of eyes as to how things are shot. And I know it's not going to be in your own backyard, but that's something that's going to attract tourists from across the world. Do we know any contract wise as to like at the Las Vegas sphere in Vegas? If that stuff is shot, is it contracted through some of the filming? Do you know whether or not it's through
I,
IMAX?
I don't know that we could look into that, but I will confirm something. Morgan Stanley at their media and telecom conference highlighted IMAX, saying that this is the trend for filming in the future, and think
100%.
that Dune 2 is starting a new trend for the way that movies are going to be filmed.
Huh. So that would basically outline growth catalysts for the company, I would say. So let's look at our next column, with this company, gross margins. They look strong as well. Can you outline some of that?
Yeah, so the gross margins in this industry is for them is they want to be at that 50% as well, approximately. But they're
Yep.
at 57.5. So this is really strong. So they have the margins there, and they have the growth potential as well that they're executing on.
Okay. Next up, levered free cash flow. What are we seeing along with, this is definitely a capital intensive industry that they operate in. So what can you share with us?
Well, it's flat. So any money that they're getting into the bank, they're reinvesting into the business. And you're not going to see that when you look at net income or EBITDA or
Yeah.
others, because of the way accounting works. But this is something that I look at is like, I've been in capital intensive businesses before as an investor and
Yep.
also as an owner myself. And I kind of shy away from anything that needs a lot of capital. It doesn't mean it's wrong. But when I look at this number, that's the one yellow flag for myself.
Okay. So net income and credit check. Can you highlight those last two stats?
Yeah, it's strong. So they have $27 million of net income and much more in other measures like EBITDA and such above the line. But so when we run it through the credit check, even though their leverage free cash flow is flat, they still have a strong balance sheet. They came in at 5.7 for the credit check. So that's way above the 3. So it's strong. But we can see why it's lower than the first company we looked at is because of the level of capital intensity of the business.
Good to know. Okay. Moment of truth. Do you give it the TDR Small Cap Sunday stamp of approval to own this stock?
You know, I'm so fascinated with this business, and I just love Dune 2 and what they're doing. And I'm just so intrigued by how they're moving to get so many people sitting in IMAX theaters because of their cameras.
Yep.
I just shy away from capital intensive businesses. It's something that
Okay.
scares me. And so I
Such a
think I'm
no.
just I would be at, well, I think it's not a no and it's not a yes, but I think it's for investors that have to be aware that it's capital intensive. And if that's okay with them, then they have to make their own decision. But for myself, I would sit on the sidelines for now.
Okay. Walking a fine line here tonight, huh? All right, let's move on to our third company, Andrew Peller Ltd. You guys have probably have seen this a lot, Peller Estates, but they actually are a wine company in the Niagara region in Niagara Falls, Canada. Like I said, formerly known as Peller Estates. This company, they've been paying a dividend for 44 straight years. But what's crazy is really no one's commented on this stock online since like 2019. So why do you think that is?
Yeah, even then, and that stat was regarding Seeking Alpha. Not even retail investors made a comment about this company. I'm just in disbelief that there's not more interest in people following a company that's paid a dividend for 44 years and has been increasing. And also for those that are interested in cannabis, this is a very interesting name because they're vertically integrated. They go right from grape to selling the final product in a store owned by themselves. So it's completely vertically integrated. It's a very intriguing business that has interesting names attached, like Wayne Gretzky as well, for their brands.
All right. So this trades on the TSX, the Toronto Stock Exchange, under the ticker symbol ADW.A. So let's dive into their revenue and their compound annual growth rate, along with some growth numbers for the entire industry. What can you highlight based off of that?
So their compounded growth rate has only been 1% over the last 5 years, but I'll give some commentary about that. I read through all their annual reports. They had a lot of supply chain issues in the last 5 years.
Yeah.
They know that similar, we saw this in automobiles and in different industries. They couldn't get the simple things that they needed for manufacturing and also for production post COVID and during COVID. They could have a lot more production, but they just can't simply get what they need. Now they've made in their last statement, they feel that they have fixed their supply chain issues. And I believe that. That seems credible. We see this, there's cars for sale on car dealership lots, and you can get chips now for computers and such. So this seems credible. So they feel that that is going to be their growth catalyst now that they've solved their supply chain issues.
Okay, so supply chain issues here in 2024, you think has definitely changed and turned a corner from compared to what we were post-COVID. Clearly, so a lot of those questions have been answered here in 2024 is what you're suggesting.
Yeah, they've done well here. It seems credible to me. They've also made some other improvements that'll help their bottom line besides just revenue. And they've done stuff like they've restructured some of the debt that they had. They've restructured at a lower rate of interest as well. And so that'll flow through down into their net income and leverage free cash flow as well.
44 consecutive years providing a dividend. That's impressive to say the least. So what is the yield and growth?
Yeah, so this, and I want to take a break about talking a little bit of why this is so important too. So their yield now is 6.5%. Their growth rate of their dividend over the last 5 years has been 6.6%. Now let's go back to school a little bit, and this is going to be important for company number 4 as well. The CFA program is 3 years, but if I can give you the most important thing that you can learn in that program, it's very simple. It's a way to predict the future return of dividend stocks.
Okay.
So simple formula. Just take the growth rate of dividends and add the dividend yield. That's almost been perfectly a predictor. So they have 6.5 plus 6.6. So you can see that a little over 13% is what the expected return for this dividend stock is. This only applies for companies that are focused on dividends, which company number 3 today is and company number 4. But that's a metric that one can use. So as a rule of thumb, when I look at this, that looks potentially like a quite attractive return for dividend investors.
That's interesting to say the least, and simple, straightforward.
Yeah, and I'll give you another. So some people would question, how is a company growing at their dividend at 6.6% when their revenue over the last 5 years only grew at 1%? And this is through operational efficiency by doing things like lowering their debt costs and stuff. That's something that can only be done once. You can make more efficiencies, over the years. You can, just do one thing at a time. Eventually, you can't do it anymore. But this is now they're on the cusp of getting over this supply chain issue. So I think that's where the growth is going to come. That'll support the continued increase in dividends as well.
Okay, like the previous 2 companies, let's look at the charts now. So what is their, just how about gross and free cash flow, gross income and free cash flow?
Yeah, so they have leveraged free cash flow of 24 million and net income is flat. So that's a good question. This is very important for company 3 and company 4. How can your leverage free cash flow be higher than your net income? This is typically because of using depreciation for an expense, which you write off. And it's a way to lower your taxes as well. It's positive for shareholders. So this is why it's so important to not just look at net income or earnings, but to look at leverage free cash flow. Because I can see that this company has cash in the bank, can pay their dividends from money that they're earning, but it's not reflective in their net income. And that on a first glance, someone could cast this company aside because they think their earnings are flat. But on further look, they're actually not.
So don't get fazed by the net income being flat in this particular situation. Look beyond is what you're suggesting.
Yeah.
Okay. All right. Moment of truth. First off, credit check, and then we'll get into moment of truth as to whether or not you would own this stock. But credit check outlined what?
Came at 8.6, so way above the 3 to get into the green flag area. So they're strong for sure. Okay. And I know the next question is coming. So what is the moment of truth? I would buy this company because I like dividends. I love growing dividends. I would want to do a little bit more research. I'm going to reach out to the company this week to do a little bit more, see if I can get an interview with them, a call, and find out more just about their growth catalyst outside of resolving supply chain issues.
Okay. So again, a reminder, they trade on the TSX, ticker symbol again
And
is
so
what?
it's ADW.A. And for our friends that wish to purchase it in the US, they can buy it over the counter at ADWPF.
All right. Let's now switch to our final stock here this evening. And I'm sure some of our viewers will be extremely happy because it belongs in the cannabis industry. Full disclosure, I will let everyone know here too that NewLake Capital is a client of us here at the Dales Report, but we try to give basically a honest, unbiased choice or decision on what this company looks like as we provide this information for you. So as we focus on NewLake, company based out of in Connecticut, which a lot of people know. Company again familiar with, trades on the OTCQX under the ticker symbol NLCP. So when you look at the growing trend of cannabis, what do you think are some of the numbers that pop out to you, Bill, that are going to take place here over the next 10 years pertaining to their business?
Yeah, so their business, first of all, is based on the real estate side of cannabis, but it's very important that cannabis is growing in the long run to make sure that their tenants are doing well financially in
Right.
an industry that is growing. And in this case, cannabis over the next 10 years is expected to grow at about 10.5% a year in the US. So it's at a very strong market compared to GDP growth. You know, maybe it's expected to be 3% a year over the next 10 years. Cannabis is expected to significantly outpace that.
Yeah, one of the few companies in the entire industry as well that provides a dividend. Share with us the details of what they've been able to perform over the last year or two.
Yeah, so in their business, they are basically tenants of real estate to cannabis, or they're landlords of cannabis real estate, and their tenants are cannabis companies. With this, they've structured a fairly simple, clean model. That what they do is they build this structure, they take in the money from the cannabis companies and manage it. They take a narrow, thin charge for doing that, and then they push out the return as dividends to
Yeah.
investors. Yeah, so we can look at that more in detail.
Okay, let's bring up the chart. Let's look at the levered free cash flow and net income. What are you seeing?
So yeah, this is a very strong business. They have $40 million of leverage free cash flow in the last 12 months. But what is so incredible in creating that is their gross margin profit. So remember, we said a rule of thumb, a lot of companies want to get to 50% gross marginal profit. They're
Yeah,
at 98.6.
massive, massive. That is something you need to outline it once or twice. That's huge.
Like just so, okay, so let's go back to think about that. Companies want to get to 50%. That's
There.
the goal. They're at 98.6.
Yeah.
So this
So
is that's really, when you look, that's a cash flowing business on gross margin.
all right. So when you're looking at a healthy gross margin, the idea is to get to 50%. And again, reminders that NewLake is at 98%. So even like outside of NewLake, when you're looking at basically an earnings sheet, when you look at a healthy gross margin, that's the number that you want to look at is right around 50% is what you're outlining, correct?
Yeah, and so that I'd be very happy, you know, when you look at companies that are around 50%, but they're at 98.6. It's just so abstract to think of how cash flow positive that business and how low the actual expenses are.
Wow. All right. Credit check. What'd you find?
Yeah, so their credit came in at 11.6. This is no surprise. So when you
Strong.
think of REITs, the big problem with REITs is they do fantastic unless you get into problems with your debt. So when interest rates are rising or you have too much debt and your asset values are going on, that's how REITs end up into a bad news situation. NewLake essentially is debt free.
Yeah.
They have about $1 million of debt. This is out of the REITs I compared it to in depth to make a benchmark. They're the only one that are debt free. Yet they're producing similar leverage free cash flow per dollar that the REITs that are using lots of leverage. So what would you prefer when buying a company? Would you want to buy a company that needs lots of debt to make to make a certain amount of leverage free cash flow, or one that doesn't use debt? Well, obviously one that doesn't. So this shows how strong their business is, and that they can produce excellent returns and leverage free cash flow without using debt.
All right, moment of truth. Would you own the stock?
Absolutely. The dividends, 8.2 right now, and the dividend growth last year was 5.13. So that brings it to 13.3. So that was remember the rule of thumb, just adding the dividend growth and the dividend yield. But another thing is, though, we're going to step back. There's another way you can also look at this, is what happens if this company becomes to pay a similar yield to its competitors. That means its value has to go up. So potentially, we're releasing a report this week. We did a bunch of in-depth analysis on this. Take a look at that report on Monday or Tuesday when it comes out, and you're going to see what we think the expected return is of this stock based on the dividend returning to the mean of the other companies in its benchmark. It's going to be an exciting report to look at.
Well said. And if you want to learn more about that, everyone, make sure to subscribe to the Baked In newsletter, the link here at the lower right-hand corner. So make sure to subscribe as usual, smash that like button, leave lots of comments, and give us a recap of the companies that we basically followed here today. Do you like what we did? We obviously want to cover in cannabis. We're going to include one company every single week. We also want to cover industries that complement this space, beverage and even entertainment, things that you like. So let us know what you thought. Leave comments below. And as well, in addition to the NewLake report, we're also going to highlight the 4 companies that we're going to feature on next week's show. So make sure to subscribe and learn about stocks that you may not be familiar with. And we'll shed some light on you with our professor, TDR, head of research and a lead financial writer, Bill McNarland. This has been great. So this has been good. So we've got 2 thumbs up for companies that you'd basically own. And then the other 2, there's more information that you want to learn more about. But all in all, I thought this was great.
Yeah, enjoyed it. It was fun to do all the research during the week, and looking forward to next week. And if there's any companies people want to look at, just mention it in the comments.
Yeah, for sure. As usual, like I say during the week, and I just top line it again, hit lots of likes, leave lots of comments. We love, obviously, the feedback and conversations. The more and more we can actually have these conversations, the greater chance that we create this platform for going viral and highlighting a lot of the companies in the industries that we cover. So be the first to know, and then subscribe to your network. Appreciate the time. Bill, enjoy the rest of your weekend, and we will check back in with you early next week. In the meantime, take care.
You too.
Hey, everyone. Thanks again for watching. Hey, we're humming along, and it's all because of you and the audience and community that we're building. So, again, make sure to smash on that like button and leave lots of comments. Who do we have up next? You let us know. Who should we interview? What companies? Is there anything you like? Is there anything we're missing? We're all here for you. Let's get on with each other and build this community for all of us to benefit. As usual, don't forget to subscribe to our channel, because in the end, we wouldn't be here without you. Thanks again, everyone.